Risk is inevitable. Being prepared isn't. What happens if property prices fall? What if a property takes longer to sell? How do SPVs, debenture trustees, and continuous monitoring help protect investors? In this video, we'll simplify the intermediate level FAQs on risk management and investor protection in GHL India asset secured NCDs, helping you understand how investment risks are managed. Let's understand how it works. One, what happens if the property value falls? Real estate values, like other asset classes, may fluctuate due to changes in economic conditions, interest rates, market sentiment, infrastructure development, or government policies. A decline in property value is therefore one of the risks that every real estate investor should understand. At GHL India Asset, our investment philosophy is designed to reduce the impact of such market fluctuations through disciplined acquisition, careful due diligence, and structured risk management. How does GHL manage the risk of a decline in property value? 1. Acquisition at disciplined valuations. We aim to acquire properties at valuations that align with our investment strategy after detailed market analysis and due diligence. A disciplined acquisition approach can provide a margin of safety compared with purchasing assets at inflated prices. 2. Comprehensive market assessment. Before investing, we evaluate local market demand, planned infrastructure developments, growth corridors, economic activity, exit opportunities, long-term development potential. This helps us select locations with favorable long-term prospects. 3. Pistol-based investment analysis. Our investment decisions consider broader macroeconomic and regulatory factors through a structured pistol analysis, including political, economic, social, technological, legal, environmental. This enables us to identify external risks that may influence property values. 4. Continuous market monitoring. Property markets evolve over time. Accordingly, we monitor market trends, regulatory developments, infrastructure progress, buyer demand, economic indicators. This helps us adapt our strategies where appropriate. Does a temporary decline in property value automatically result in a loss? Not necessarily. A temporary reduction in market value does not automatically result in a realized loss. A loss generally occurs only if an asset is sold under circumstances where the sale proceeds are insufficient to recover the investment. Market fluctuations are a normal feature of real estate investing, and outcomes depend on various factors, including market conditions at the time of exit. What should investors understand? Professional investors recognize that property prices do not move in a straight line. Markets experience periods of growth, stability, and correction. Investment decisions should be based on long-term fundamentals rather than short-term price movements. Important clarification. Short-term price movements are part of every real estate market. Disciplined asset selection and long-term investment principles are key to managing market fluctuations. Many investors assume that property prices only increase. In reality, real estate markets are cyclical. Understanding market cycles is an important part of responsible investing. Can property prices fall? Yes, they can. That's why successful investing isn't about predicting every market movement. It's about buying carefully, understanding market cycles, and managing risk through disciplined investment decisions. A decline in property value is a market risk, not an automatic capital loss. Disciplined investment selection, long-term perspective, and continuous monitoring are essential components of effective risk management. Professional investors do not expect markets to move only upward. They prepare for market cycles and invest with discipline. 2. What happens if the property cannot be sold within the expected timeline? Real estate investments are influenced by market conditions, buyer demand, regulatory developments, financing availability, and other external factors. As a result, the sale of a property may sometimes take longer than originally anticipated. At GHL India Asset, we recognize this as an execution risk and incorporate it into our investment planning and risk management framework. While every effort is made to execute the investment strategy efficiently, actual timelines may vary depending on prevailing market conditions. What can cause a delay in property sale? A property may take longer to sell due to factors such as temporary slowdown in the real estate market, reduced buyer demand, changes in interest rates affecting purchasing decisions, delays in infrastructure development, regulatory or approval-related developments, broader economic conditions. These are external factors that may influence transaction timelines. How does GHL manage this risk? 1. Careful property selection. Before acquiring a property, we assess market demand, location potential, future infrastructure, exit opportunities, buyer profile. This helps improve the likelihood of achieving a successful exit. 2. Conservative investment planning. Our investment decisions take into account that actual project timelines may differ from initial estimates. Planning with reasonable contingencies supports better project management when unforeseen circumstances arise. 3. Continuous market monitoring. Throughout the investment period, we monitor buyer demand, market trends, pricing conditions, infrastructure progress, regulatory developments. This helps us make informed decisions as market conditions evolve. 4. Active exit strategy review. If market conditions change, we continuously evaluate the most appropriate exit strategy based on commercial considerations and prevailing circumstances. The objective is to pursue an exit that aligns with investor interests while responding to market realities. Does a delay automatically mean the investment has failed? No. A delay in selling a property does not necessarily indicate that the investment has failed. Real estate is a relatively illiquid asset class, and transaction timelines can vary depending on market conditions. The overall outcome depends on several factors, including the quality of the asset, market demand, and prevailing economic conditions at the time of sale. What should investors understand? Professional investors understand that estimated timelines are based on assumptions and market conditions at the time of planning. Actual execution may vary. Patience and disciplined decision making are important in real estate investing. Important clarification. In real estate investing, success is determined not by the speed of an exit alone, but by disciplined execution and informed decision making throughout the investment life cycle. Many investors assume that every project will conclude exactly as scheduled. In reality, real estate markets are dynamic, and execution timelines may change due to factors beyond the control of the investment manager. What if a property doesn't sell on time? In real estate, timelines can change because markets change. At GHL India Asset, we continuously monitor market conditions, review our exit strategy, and make disciplined decisions based on prevailing circumstances, not emotion. Delays in property sales are a recognized execution risk in real estate investing. Effective planning, continuous monitoring, and disciplined decision making help manage this risk, although timelines cannot be guaranteed. A well-managed investment is measured not by whether every milestone occurs exactly on schedule, but by how effectively challenges are managed when circumstances change. 3. How does the SPV structure reduce investment risk? At GHL India Asset, each real estate project is typically undertaken through a dedicated special purpose vehicle, SPV. An SPV is a separate legal entity created for a specific project or investment. This structure helps organize project operations, maintain financial discipline, and ring-fence project-specific obligations. While an SPV does not eliminate investment risk, it is widely used in project finance and real estate transactions because it provides greater transparency, accountability, and structured risk management. Why does GHL use a project-specific SPV? The SPV structure allows each project to operate independently. This means that each project has its own assets and liabilities. Project-related financial records are maintained separately. Cash flows are monitored at the project level. Project performance can be evaluated independently. This improves governance and operational clarity. How does an SPV support risk management? 1. Ring fencing of project risks. Each project is structured independently. This helps ensure that the obligations and performance of one project are managed separately from those of another project. 2. Greater financial transparency. Each SPV maintains its own financial records. This enables better monitoring of project cash flows, clear accounting of project expenses, improved financial reporting. 3. Improved governance. A dedicated project entity supports better operational oversight, clear documentation, defined responsibilities, more effective project monitoring. 4. Efficient project monitoring. Because each project is managed separately, progress can be tracked more effectively, including acquisition milestones, legal compliance, development progress, exit planning, cash flow performance. 5. Structured security creation. Where applicable, the security for the secured NCDs is created over the assets of the relevant project in accordance with the trust deed and applicable laws. This provides a clear legal framework for the security supporting that investment. Does an SPV eliminate investment risk? No. An SPV is a risk management and governance tool, not a guarantee against loss. Real estate investments remain subject to market, regulatory, legal, operational, and execution risks. The purpose of the SPV is to provide a structured framework for managing those risks more effectively. Why is the SPV structure preferred? Professional investment managers often use SPVs because they promote better governance, financial discipline, project-level accountability, operational transparency, structured risk management. These features support responsible investment management throughout the project lifecycle. Important clarification. An SPV is not designed to remove investment risk. It is designed to manage projects with greater transparency, accountability, and financial discipline. Some investors assume that multiple companies increase complexity. In reality, project-specific SPVs are commonly used to improve governance, accountability, and risk management by separating one project's operations from another's. Why does GHL create a separate company for every project? Because each project deserves its own financial records, governance, and risk management. A project-specific SPV helps improve transparency, accountability, and structured investment management. An SPV is a project-specific legal structure that supports governance, transparency, financial discipline, and risk management. It is an important safeguard within GHL's investment framework, but it does not eliminate investment risk. Strong investments are built on strong structures. The SPV model brings discipline, transparency, and accountability to every project. 4. What role does the debenture trustee play during financial stress? A debenture trustee is appointed to act in accordance with the terms of the debenture trust deed and applicable laws for the benefit of the debenture holders. During periods of financial stress, or if the issuer experiences difficulty in meeting its obligations, the trustee performs its responsibilities as specified in the trust deed and applicable legal framework. The trustee acts as an independent fiduciary for the debenture holders and plays an important role in overseeing the security created for the secured NCDs. What does the debenture trustee do? The trustee's responsibilities generally include holding or overseeing the security created for the benefit of debenture holders, monitoring compliance with the terms of the trust deed, acting in accordance with the rights and remedies available under the trust deed and applicable laws, communicating with debenture holders where required, taking appropriate steps if an event specified in the trust deed occurs. The trustee acts independently and is expected to perform his duties in accordance with the applicable legal and contractual framework. What happens during financial stress? If the issuer faces financial stress, the debenture trustee may, subject to the trust deed and applicable law, review the situation and the issuer's compliance with its obligations. Engage with the issuer to understand the circumstances. Consider the remedies available under the trust deed. Take actions that are permitted under the governing documents and applicable laws for the benefit of the debenture holders. The specific actions available depend on the facts of the situation and the terms of the trust deed. Why is an independent trustee important? The appointment of an independent debenture trustee provides independent oversight, a structured governance framework, protection of the security interest created for debenture holders, representation of debenture holders' interests within the scope of the trust deed. This enhances confidence in the investment structure. Does the trustee guarantee repayment? No, the debenture trustee does not guarantee repayment or eliminate investment risk. Its role is to perform the responsibilities assigned under the trust deed and applicable laws, including overseeing the security and acting in the interests of debenture holders within the scope of its authority. Important clarification. The debenture trustee is an independent safeguard within the investment structure, providing oversight and acting in accordance with the trust deed for the benefit of debenture holders. Some investors assume that a debenture trustee is a guarantor of repayment. In reality, the trustee's role is to oversee the security and act in accordance with the trust deed and applicable laws, not to guarantee investment returns or repayment. Who protects investors? If a company faces financial stress, that's where the debenture trustee plays an important role. The trustee independently oversees the security created for the secured NCDs and acts in accordance with the trust deed and applicable laws for the benefit of debenture holders. The debenture trustee is an independent fiduciary who oversees the security created for the secured NCDs and performs its responsibilities in accordance with the trust deed and applicable laws. This strengthens the governance and investor protection framework but does not eliminate investment risk or guarantee repayment. Strong governance is built on independent oversight. The debenture trustee is a key part of that governance framework. 5. How are risks monitored throughout the investment tenure? At GHL India, asset risk management does not end once an investment is made. We believe that continuous monitoring is an essential part of responsible investment management. Throughout the investment tenure, we regularly review project progress, market developments, legal compliance, financial performance, and other factors that may influence the investment. The objective is to identify emerging risks at an early stage and take appropriate management decisions in response to changing circumstances. What areas are monitored? Our monitoring framework typically includes 1. Project progress. We regularly review the status of each project, including acquisition milestones, documentation status, project execution, exit planning, key commercial developments. This helps ensure that the project continues to progress in line with its investment objectives. 2. Market conditions. Real estate markets are dynamic. Accordingly, we monitor buyer demand, market pricing trends, competing developments, infrastructure progress, local economic activity. These factors help us evaluate whether changes in market conditions require adjustments to our strategy. 3. Legal and regulatory developments. We monitor developments that may affect the investment, including changes in applicable laws, land-related regulations, approval requirements, government policies, judicial developments that may impact the project. 4. Financial performance. Project-level financial performance is reviewed, including cash flow position, project expenses, funding requirements, budget performance, financial reporting by the SPV. This supports disciplined financial management throughout the investment lifecycle. 5. Risk indicators. We also monitor key indicators that may signal emerging risks such as delays in execution, changes in market sentiment, cost escalations, regulatory developments, other project-specific risk factors. Early identification enables timely evaluation and response. Who monitors these risks? Risk monitoring is carried out through GHL's internal governance and project management processes. Depending on the nature of the issue, inputs may be obtained from legal, technical, financial, and commercial professionals to support informed decision-making. Why is continuous monitoring important? Real estate projects typically extend over a period of time, during which market conditions and regulatory environments may evolve. Continuous monitoring enables the investment manager to stay informed about changing conditions, evaluate emerging risks, review project strategies where appropriate, make timely and informed decisions. GHL Continuous Risk Monitoring Cycle. Investment commences, project progress review, market monitoring, legal and regulatory review, financial performance review, risk assessment, management review and action. Continuous monitoring until maturity. Important clarification. Successful investing is not achieved by making one good decision at the beginning. It is achieved through disciplined monitoring and informed decision making throughout the investment life cycle. Some investors assume that investment management ends once funds are deployed. In reality, continuous monitoring is one of the most important responsibilities of a professional investment manager. Making an investment is only the beginning. At GHL India Asset, we continuously monitor project progress, market conditions, legal developments, financial performance, and emerging risks throughout the investment tenure. Responsible investing requires continuous oversight. Continuous monitoring is a core component of GHL's risk management framework. By regularly reviewing project progress, market developments, legal compliance, financial performance, and emerging risks, we seek to support informed decision making throughout the investment life cycle. The quality of investment management is reflected not only in the investments selected, but also in the discipline with which they are monitored. Understanding investment risk is one thing. Understanding what happens when things don't go as planned is even more important. In the next episode, we'll explore the advanced level of risk management, investor protection in GHL India Asset secured NCDs, covering default scenarios, how security cover works, investors' legal rights during enforcement, as well as the essential risk checks and due diligence every investor should complete before investing. Know the risks, understand the protection. See you in the next episode.